The cryptocurrency market was a realm of unprecedented growth. Bitcoin, the pioneer, led the charge. Ethereum, with its smart contracts, expanded the possibilities. Thousands of cryptocurrencies emerged, each promising to revolutionize finance and technology. Investors flocked to this new frontier, drawn by the potential for high returns. The market soared to dizzying heights, creating fortunes for early adopters. But this rapid ascent masked underlying vulnerabilities. The allure of quick riches attracted both seasoned and novice investors. Traditional financial institutions started to take notice. Governments grappled with how to regulate this decentralized and rapidly evolving space. However, amidst the euphoria, warning signs began to emerge. The market was driven by speculation rather than fundamental value. This made it susceptible to manipulation and sudden shifts in sentiment. The rapid growth of the cryptocurrency market was unsustainable. A correction was inevitable. The question was not if, but when, and when the crash came in 2022, it sent shockwaves through the financial world. Several factors contributed to the 2022 cryptocurrency crash. Global economic uncertainty played a significant role. Inflation soared to record highs in many countries. Central banks responded by raising interest rates. This made traditional investments more attractive and reduced the appetite for risky assets like cryptocurrencies. The war in Ukraine also added to the market volatility. Geopolitical uncertainty led investors to seek safer havens for their capital. This further dampened the demand for cryptocurrencies. Additionally, the collapse of Terra USD, a stablecoin designed to maintain a peg to the US dollar, shook investor confidence. This event triggered a domino effect across the market. Regulatory scrutiny also intensified in 2022. Governments around the world expressed concerns about the lack of oversight in the crypto space. They worried about its potential use in illicit activities. Calls for stricter regulations and investor protection measures grew louder. This uncertainty over future regulation created further unease among investors. The cryptocurrency crash of 2022 was not a single event but a chain reaction. It began with a gradual decline in prices fueled by the factors mentioned earlier. As prices fell, investors started to panic. Fear of further losses led to a sell-off, exacerbating the downward spiral. This created a domino effect as one cryptocurrency after another tumbled. Bitcoin, often seen as a bellwether for the market, experienced a sharp decline. Ethereum, the second largest cryptocurrency, followed suit. Altcoins, or alternative cryptocurrencies, suffered even greater losses. The collapse of Terra USD and its sister token Luna amplified the panic. Investors realized that even stable coins designed to be less volatile were not immune to market forces. The interconnected nature of the cryptocurrency market meant that a problem in one area could quickly spread to others. The use of leverage, where investors borrow money to amplify their bets, magnified the losses. As prices plummeted, investors facing margin calls were forced to sell their holdings, further driving down prices. The 2022 cryptocurrency crash had a devastating impact on many retail investors. Individuals who had poured their savings into cryptocurrencies, hoping for life-changing returns, saw their investments evaporate. For some, the losses were financially crippling. The crash highlighted the risks associated with investing in highly volatile assets. Many retail investors lacked the knowledge and experience to navigate the complexities of the cryptocurrency market. They were often lured by hype and promises of easy money without fully understanding the underlying technology or the risks involved. The lack of regulation and investor protection mechanisms in the crypto space left many individuals vulnerable. When the market crashed, they had limited recourse to recover their losses. The emotional toll was significant, with many experiencing anxiety, stress, and a sense of betrayal. Picking up the pieces, the aftermath of the crash. The 2022 cryptocurrency crash left a trail of destruction in its wake. Billions of dollars in market capitalization were wiped out. Numerous crypto projects failed, their promises of innovation dashed against the rocks of reality. The crash exposed the vulnerabilities of the nascent industry. The aftermath saw a wave of bankruptcies and closures in the crypto space. Companies that had once ridden the wave of optimism were forced to shut down. Jobs were lost, and investors were left licking their wounds. The crash also led to increased calls for regulation. Governments and regulatory bodies around the world recognized the need for greater oversight of the cryptocurrency market. The focus shifted towards protecting investors, preventing market manipulation, and curbing illicit activities. The industry itself began to introspect, recognizing the need for greater transparency, accountability, and self-regulation. The regulatory tightrope, balancing innovation and protection. The 2022 cryptocurrency crash highlighted the need for a delicate balancing act. On the one hand, regulators need to protect investors and ensure market integrity. On the other hand, excessive regulation could stifle innovation and hinder the growth of this emerging technology. Finding the right balance is crucial. Overly burdensome regulations could drive cryptocurrency businesses underground, making them even less accountable. It could also push innovation to other jurisdictions with more favorable regulatory environments. However, a complete lack of regulation would leave investors vulnerable to fraud and manipulation. The challenge for regulators is to create a framework that fosters innovation while mitigating risks. This requires a nuanced approach that takes into account the unique characteristics of cryptocurrencies and blockchain technology. It also requires collaboration between regulators, industry participants, and technical experts. Learning from the crash, a roadmap for the future. The 2022 cryptocurrency crash was a painful but valuable lesson for all stakeholders. It underscored the importance of investor education, risk management, and regulatory clarity. It also highlighted the need for a more resilient and sustainable crypto ecosystem. Investors need to approach the cryptocurrency market with caution. They need to understand the volatile nature of cryptocurrencies and the risks involved. Thorough research, due diligence, and diversification are essential. It's also crucial to invest only what one can afford to lose. The industry itself needs to prioritize transparency and accountability. This includes providing clear and accurate information about crypto projects, their risks, and their potential returns. Building trust is essential for the long-term health of the crypto ecosystem. The enduring allure of cryptocurrency. Despite the 2022 crash, cryptocurrency continues to hold allure. The underlying technology, blockchain, has the potential to revolutionize various industries. Its decentralized, transparent, and secure nature offers solutions to long-standing problems. Cryptocurrency offers the promise of financial inclusion, allowing the unbanked to access financial services. It can facilitate faster and cheaper cross-border payments. Its use cases extend to supply chain management, digital identity, and intellectual property protection. While the crash exposed vulnerabilities, it also demonstrated the resilience of the technology and the community behind it. The market recovered, albeit slowly, indicating continued belief in the long-term potential of cryptocurrencies. Building a more resilient crypto ecosystem. The 2022 crash served as a wake-up call for the cryptocurrency industry. It highlighted the need to build a more resilient ecosystem that can withstand future shocks. This involves addressing the factors that contributed to the crash. Strengthening risk management practices within crypto businesses is crucial. This includes implementing measures to prevent fraud, money laundering, and market manipulation. Improving cybersecurity is also paramount to protect against hacks and theft. Building trust is essential. This requires greater transparency from crypto projects, clear communication from industry leaders, and responsible reporting from the media. Education is key to empowering investors to make informed decisions. The future of finance, decentralization, and beyond. The 2022 cryptocurrency crash was a significant setback, but it did not derail the broader trend of decentralization. The principles that underpin cryptocurrencies, transparency, security, and empowerment, remain relevant. The future of finance likely involves a hybrid model. Traditional financial institutions are exploring the potential of blockchain technology. Central banks are researching central bank digital currencies, or CBDCs. Decentralized finance, or DeFi platforms, are offering alternative financial services. The cryptocurrency industry is evolving, learning from its mistakes and adapting to the changing regulatory landscape. While the path forward may be uncertain, the potential of this technology to transform finance and beyond remains undeniable. The 2022 crash, while painful, may ultimately serve as a catalyst for a more mature, resilient and inclusive financial system.